Well, all right. Okay. Well, hello, everyone. Happy Tuesday. Welcome to the Economic Innovation Group's OZ webinar series. We've been doing these webinars almost monthly for the past 2 years. And so we're really excited to continue and have our really great guest speakers today talk about what I think and we think is a very, very important topic. We're talking about investing in severely distressed opportunity zones. So investing in the communities that need it the most. I'm joined today by Canton District from the Economic Innovation Group. He's going to share an overview of the report that just came out from GAO, as well as some additional information, whatever he chooses to talk about. We give Canton the floor. And just to introduce myself, my name is Rachel Riley. I'm with Aces and Archers, and I work closely with EIG to host this series. As we're talking about investing in distressed communities, we've asked our guest speakers to do deep dives on two investments, opportunity zone investments. One is in Pittsburgh and the other one is in Baltimore. And so we're going to have Jonathan Tower and Anita Graham from Arcturus Impact Investors talk about Pittsburgh, and then we're going to kick it over to Ben Siegel to talk about what's happening in Baltimore. And before we start, just a few housekeeping items. This webinar will be recorded, and we typically do a blog recap. And so that recap will include the recording and the slides, so you can access this into the future. And as always, we had that disclosure at the very bottom there. I'm just going to read it for folks. It says that the material and information provided is for informational purposes only. It does not constitute an offer to sell or solicitation of an offer to buy any interest in an opportunity fund or any other securities. Any such offering will be made only in accordance with the terms and conditions set forth in a definitive agreement and will be made in reliance upon an exemption from registration under the United States Security Act of 1933 as amended. So that is what the disclosure says, just for folks who may not be able to read that at this moment. We can go to the next slide. So our agenda, I kind of ran through it, but of course, we're going to, as always, provide some OZ updates and resources. Kennan's going to do a deep dive into the Government Accountability Office report, that GAO report that came out, last week or the week before, very, very recently. And then we are diving into the meat of the content. So we're going to talk about examples of investment activity, anticipated positive outcomes of OZ investments, how OZ financing is enhancing efforts locally on the ground, and any insights on investing in severely distressed opportunity zones. Go to the next slide here. So for our updates and resources section, I will include these in the chat towards the end of our webinar, so you guys have these as references. But both the GAO report as well as EIG's analysis of the GAO report are available online. We also wanted to provide a reminder that EIG did updated fact sheets for opportunity zones last month. So we talk about investment activity, proposed legislative improvements, as well as the socioeconomic characteristics of OZ communities. And I mentioned the blog recap. We have a blog recap up now from our October webinar, and that was a discussion on designing opportunity zones and initiatives that benefit underserved residents. And from here, I'm going to turn it over to Canton.
Okay, thank you, Rachel, and thanks everyone for joining us today. So I'll try to give you a brief recap of the Government Accountability Office report that came out. I believe it was last week, although funny things are happening with time, so I'm not 100% sure. Yeah, it was the second report of the second of two that Congress requested into kind of the initial period of OZ's passage and early implementation. So it marks a milestone in kind of the reports that Congress asked to be done into how OZs are shaping up. So the headlines from the report on investment volumes were quite interesting. So they found that the OZ incentive has supported at least 29 billion in new investment, and that was just in the year 2019. That's all the information that even the government is able to really tabulate, or different arms from the government from the IRS, especially given subsequent pandemic era tax filing extensions and things like that. So this 29 billion figure is significantly higher than previous estimates, which includes one that came out in a widely cited April 2021 working paper of 18.9 billion raised. So this just reflects a more comprehensive examination of IRS Form 8996 filings. And even then, this number is incomplete filings. So there are still some paper filings and other delayed ones that they were not able to capture. So this is the first year, as this timeline shows. This is the first year of OZs. It was still kind of a year of premature market development. Regulations weren't finalized yet, and this 29 billion number puts a pretty conservative figure on the scale of money that was raised. And the GAO also identified nearly 18,000 individual investors across nearly 7,000 qualified opportunity funds that are active here in the market. And that's a significant uptick from numbers that were previously reported too. So the scale of the market was large already in 2019. It's since grown by multiple factors. Private estimates from Novogradac and all suggest that the market size has at least tripled from the period examined here. So useful information to have for sure. They also dug into, and I believe this is on the next slide. They also dug into, again, the map to kind of close the book on, what were these neighborhoods that were selected to be opportunity zones? How do they differ from other low-income communities? And tries to set the baseline for the map that many folks on this call and on this webinar are now investing off of and planning around. So they, confirms a lot of what we already knew here, right? That across every single state, the average opportunity zone has a significantly lower median household income than the average low-income census tract in general, and those that were bypassed by governors for selection. It finds that on average, the selected tracts had higher poverty rates, greater minority populations than other eligible tracts, and that all these differences were statistically significant. And the report did not examine kind of the characteristics of census tracts that received investment, but that earlier working paper from April that I mentioned from a pair of economists did. And they found there that the OZ tracts receiving investment in 2019, from a smaller sample of even what GAO was looking at, were in the top quartile nationally in terms of poverty, so very high poverty, and in the bottom quartile nationally in terms of income, so very low income. And often you'll see, a stat from that paper misquoted that the top 1% of zones received almost half of the investment, as saying the richest 1% of zones received almost half of the investment. That is not the case. Those are two things being conflated there. It says that stat says that OZ investment is concentrated relatively, especially in the early period, in a small number of tracts, but that those tracts, were not especially high income or anything. So I wanted to reiterate that point every chance I get. Then this also dug into, how states viewed the policy. And most of them have either an outright positive or a wait and see view of the policy. Here, GAO interviewed state policymakers in every state of the country, and 20 states said that they had a positive impact. OZs had a positive impact so far. 20 states said that they were still unsure and they were waiting to see. And then only one state said OZs were a net negative. We don't know which state that was or what that concern was specifically. And then they said that, states reported that most of the investments that they had seen would not have occurred without the policy. But one kind of theme of the report was a lack of data, which we're all well aware of, and that mitigates states' understanding of even what's happening in their own backyards and colors. I think their perceptions here. And starting to close us out, they also included an indicator, included a survey of a small number, 18 different opportunity funds kind of selected at random, really to get a sense of, to what extent the opportunity zone incentive changed their behavior. Has it just subsidized investments, or has it accelerated investments, or actually, driven new ones? And they said that the responses, for the most part, said that the OZ incentive is indeed driving investment that would not have otherwise occurred within these communities. So a majority, 10 out of 18, said that they're pursuing kind of these projects that passed the but-for. 4 out of 10 said that their OZ investments would have gone forward regardless, but that the incentive affected in other ways, right? So more affordable units, or happening faster, et cetera. And then all of this, GAO likes to end every report with a call to action for Congress. And here it was a very robust call for more data, which is something that we all share, as I mentioned, that the opportunity zone policy is large enough in scale and in uptake that this opacity really cannot continue, and that we need to know who's investing where, how much, etc. So let's that aligns very, very closely with EIG zone advocacy agenda. And we hope to see congressional action on that front soon, because it's pretty clear that a lot is happening and a lot of it's very good, and we need the data to know. So that's about it. I'll pass it back.
Thanks so much, Cannon. And before we go on to the next slide, I really want to highlight some of these positive outcomes, or how the policy is incentivizing activity. You mentioned it, but really bullet point here, it's brought new investors into the fold. So folks that maybe wouldn't have otherwise been making investments into communities or into these specific communities, it's brought them to the table. That means it's expanded the amount of capital that's available for financing these sorts of activities in distressed communities. Dramatically accelerated other projects. We've heard that, because you have to have a certain amount of money into projects by a certain timeline, that has been accelerating project timelines, as well as just having the available of equity capital that you don't have to come off your own balance sheet for, is helping to accelerate that timeline. Delivered capital to close financing gaps. I think that a lot of folks, this resonates with them. These capital stacks are multi-layered, and a lot of times you have to identify new sources of capital before you can fully fund a project or a investment into a business. And then allowed for a greater share of planned housing units at more affordable rates. We hear the story all the time, especially as it pertains to workforce housing, maybe hitting that missing middle section that's just so important to serve. And then, like you mentioned, it has been helpful in affecting investment decisions about where to invest. So just wanted to really underscore those really important points that I sort of knew to be true before the GAO report, but found really helpful that it was highlighted here.
Yeah, thanks, Rachel. Agree completely. And we have projects I'm sure that we could rattle off that all of us that fall under each one of those buckets and bullets that you laid out there. And that's one of the nice things about the report, is that GAO is so objective and respected and authoritative on the stuff that they went and asked a lot of the questions that we've encountered. What's the but for? What would have happened anyway, etc. And went out and tried to answer this and really set the playing field, or set the table for the conversation here. So it served a useful role there. So, thank you.
Awesome. Thank you so much for joining us, Cannon. Always good to see you. All right, so for my one slide here, I just really wanted to provide the context around distressed communities and the level of need, and specifically as it pertains to the projects that we're about to discuss. Just as an overall metric here, nearly 70% of the opportunity zones qualify as severely distressed, meaning they have the highest need of or the highest level of distress out of all census tracts, and they are very high need communities, often capital starved communities. And more than half of the country's concentrated persistent poverty census tracts are OZs. And so the designation, I think, going back to the GAO report, the designation process in general was successful, as we are seeing that the OZ designations overlap with communities of high need. What we did here was we pulled information from the Distressed Communities Index, sort of crosswalking another resource that EIG provides. And I'll put a link in if you guys want to explore the Distressed Communities Index for yourself. But we really wanted to ground this in not, like anecdotes or qualitative information about the level of need in these communities, but really to demonstrate the level of distress and distress relative to other communities that surround them. So the Pittsburgh investment that we're about to discuss has a very high level of distress. It's 97.6, and that's out of 100, correct, Kenan? Yep, out of 100. So 97.6 out of 100. And then the Baltimore project that we're going to discuss has a distress level of 95.7 out of 100. So we're talking about highly distressed communities. And with that, I'm going to turn it over to Jonathan Tower and Anita Graham from Arcturus Impact Investors to talk about their work in general, because they're working throughout the country on this very important topic around working with communities, aligned with communities, but then specifically to talk about the Pittsburgh investment. Great.
Thank you so much, Rachel and Ken. Your data and encouragement is always so appreciated, and we're thrilled to have you both as partners in this effort. I'm Jonathan Tower, founder of Arcturus Impact Investors, and my colleague Anita Graham and I are going to talk today in particular about our work in opportunity zones in Pittsburgh. But this is really through a lens of hopefully sharing and educating others from the community development community, from the community development space, to think next looking out to 2022, how are we going to apply our ARPA funds at the city level and our state small business credit initiative funding at the state level to create new programs that will help us achieve the vision of the city or a state of our wildest dreams? How do we get from where we are today to where we want to be? How do we attract that kind of private capital on top of our government capital to make these things happen? And how do we make sure that it stays on course so that the projects, whether it's affordable housing or job creation or high-speed internet access for low-income communities, how do we make sure that these maintain their mission throughout the 10-year period of opportunity zones and beyond? But first, let's start out with introductions. Love for Anita to introduce herself, and then I'll do the same.
Great. Well, thank you, and good afternoon, everyone. Prior to joining Arcturus, my career really consisted of heading up an SBIC, a small business investment company, and later a private equity fund as a partner. Both funds had an investment strategy of investing in businesses in underserved communities where capital was inefficient. And as such, in that capacity, we were constantly looking at companies in low-income distressed areas and providing capitals to communities, minority-owned businesses, women-owned businesses that really were focused on addressing capital where capital was inefficient and looking to put that capital to work. In my capacity today as a principal of Arcturus, overseeing the Baltimore market, that strategy continues. We focus on businesses in the Baltimore City market. We've been fortunate enough to complete several investments in the market. And the goal, quite frankly, is in identifying optimal companies where we can have the greatest impact in the community. So it's a pleasure to be here.
Thank you, Anita. And I'm Jonathan Tower. So prior to founding Arcturus, I was in technology venture capital, built some large companies during that period of time, and really wanted to bring that same vigor of venture capital and private equity to the ESG and impact investment space. So 12 years ago, started Arcturus with an impact focus, specifically in low-income communities around the United States, and have built that. Now we're on Fund 6. We do debt, we do opportunity zone equity, we are a community development entity, a CDE, and we're able to bring multiple tools to the communities that we serve. What we're really doing is we're helping to achieve accessible communities and help those communities reach their wildest dreams. Whatever the transformative change is that is underway, we want to help amplify that. We want to help make sure that the capital is there to see the project through and throughout. Arcturus Impact Investors is the parent company. We have multiple different funds within Arcturus, but just at a high level here, we do set strong return targets. We have investors who are commercial banks or family offices or insurance companies who believe in our impact mission very much, but who also still have a fiduciary responsibility to get a market rate return. So we have strong return targets for the investors who need that. We also have first loss capital protection, which has come from US Treasury Department, new markets tax credits, state small business credit initiatives, many different foundation partners, some of whom are listed on the bottom of the slide here, and different types of last money out and guarantees. And these are what you might categorize as government and foundation investors who are willing to take up a higher level of risk and a lower return than all the other investors in the fund. And they typically take up 10 to 20% of the total fund size, and then we provide the matching capital on top, but they are catalytic in terms of making these programs work. We started doing it back in 2009 on a deal by deal level. By 2013, we were partnered through the 2010 Jobs Act, State Small Business Credit Initiative with US Treasury and state of Michigan, and we've replicated that model ever since. We do national funds with first loss capital. And a typical question is, why are government agencies or foundations providing junior equity, last money out capital guarantees, and in some cases grants to these funds? And the key answer is community impact. We're driving job growth, not minimum wage job growth. We're driving living wage job growth. We're driving social and racial equity, and we're driving environmental sustainability in underserved communities. Again, we invest in private equity companies, we invest in affordable housing, we invest in market rate, we have some commercial real estate where we put manufacturing companies, and we're doing a ton of broadband in low-income communities around the country. All of these are part of an integrated approach to achieve successful, vibrant communities. As I mentioned, we've been doing this over 12 years. We have 6 active funds in private equity and credit. And we invest across the board in businesses, infrastructure, and real estate. I could go to the next slide. We, as we've partnered with cities and states, generally speaking, if we say, hey, we're interested in investing $50 million in your city or your state, there's generally a high degree of interest. But we, 2 years ago, had a fair amount of capital to commit to different communities, and we decided to make it a soft, friendly competition. And we asked communities from around the country to come forward with applications to say, here are our most important community development projects that are unfunded today. Here's who would benefit if these were funded. And here's how we can participate, where Arcturus would put up 80% of the money, and the government or philanthropic partners would put up a 20% match. We received 40 applications for this, and happy to report that we now have 9 programs either launched or underway as of November 2021. And in each of these are subsets of an entire national fund, and where we agreed with the local community what types of things we were going to invest in, and where we funded it and have been executing. The Pittsburgh project that we're about to talk about is part of the Pittsburgh program, which again, it's a subset of our Opportunity Zone funds. We put up $16 million of OZ equity capital, and the Richard King Mellon Foundation put up $4 million as a program-related investment. And for those of you who are with development finance agencies, which is probably most of the audience, just imagine that that's a city government, a county government, or a state economic development agency in that role too, because it would be very interchangeable. The design of the fund is that capital will be returned first to the investors, and then after a full return of capital from the entire fund, a return of capital to the Richard King Mellon Foundation. So they are agreeing to be last money out capital. And we sat down with the foundation. We said, look, I mean, we have certain impressions of what we think is needed in Pittsburgh, but let's really pencil this out. And we identified several different areas for this. One was affordable housing. One was workforce housing, one was renewable energy, one was broadband fiber, and across the board, and every one of our programs is investing in private equity operating businesses that'll create living wage jobs. And with that, I'm going to turn it over to Anita to talk about the amazing transaction that she recently completed in Pittsburgh.
Great, thank you. So one of our investments in Pittsburgh is a company identified as Snk Holdings. They DBA as Family Choice Healthcare. What was attractive about Snk Holdings, this is a company that actually was formed over 15 years ago. It's a minority-owned business, and they had established a strong base of business, and with their market focus being to address healthcare services, in-home healthcare services for the elderly and disabled, with a particular focus on the Medicaid patient. So really targeting these underserved markets. They built a baseline business, quite frankly, that's focused in Maryland, and then they started to grow through acquisitions. And so they did a couple of acquisitions, and we were able to participate in the third acquisition, which was done in Pittsburgh, where they acquired an existing business. The owner was ready to leave the industry, wanted to do some other things. It was a great opportunity, had a very strong base of business consistent with the company's strategy of focusing on Medicaid patients in 2 markets. And as a result, we were able to successfully close this transaction using our OZ equity. So we looked at it from 2 lenses. One, obviously the economic return lens, because I saw there's a question that popped up about economic, what are our expectations around returns, but also through the lens of the impact to the community. So from an impact to the community, as you can see, the company already had a significant number of employees. This increased the number of employees. We now have 325 jobs in Pittsburgh. The company is intending to grow that level of business in the Pittsburgh area. They have centralized their offices in an area of Pittsburgh in the Hill District, which is a community that we are particularly focused and impacting. Another important impact benefit, as we looked at this particular company, was the training, the workforce training that they've incorporated. So they actually will certify some of the employees that come in as entry-level employees with minimum skills. They provide a certification program for them to participate in, which gives them the opportunity for upward mobility within the company system. So that impact strategy was very important to us. Why do we think that this is a good investment? As you look at the business, we believe that there are opportunities to acquire similar businesses in and around similar markets. And as such, we've kind of looked at this deal as a platform deal for us to acquire other businesses as the company has done successfully, historically continuing to build on an acquisition strategy that will allow us to create the kind of returns that we would look for, but also impact a wider swath of the community. So this is a story for us that we're pretty excited about, impacting the community in Pittsburgh and the number of jobs we're able to not only retain, but also grow in that community. The Baltimore program, as I mentioned early on, I oversee that Baltimore program. We are super excited about this program. It's a $25 million program where we partnered with the ABLE Foundation and the Neighborhood Impact Investment Fund. That program was launched in January of 2020, right before COVID hit. And I'm pleased to say that notwithstanding the macro issues that all of us have had to deal with in our communities, we were able to successfully identify multiple opportunities in that marketplace in which we closed. One is a minority-owned grocery store that is intentional about going into food deserts. So one of our first deals is a grocery store going into an area of Baltimore in Southwest Baltimore. A second opportunity is a commercial laundry services company that currently employs over 500 Baltimore City resident employees, and with significant health benefits and living wages, in addition to the fact that it's a strong company from a financial standpoint. It really has a strong impact in the community from a job standpoint, a livable wage standpoint, and the kind of benefits that this company offers. Another business that we were able to successfully close is a business process outsourcing company, better known as a call center. But what was very attractive to us about this company was, again, its intentionality to go into low-income neighborhoods, hire from those neighborhoods, train the individuals to come into the company, similar to Snk, provide opportunities for upward mobility. And in addition, the leadership of this company assists their employees in obtaining their first home ownership, financing literacy, and most recently, they are adopting a program where they're going to have daycare on their facilities. So that combination of impact is tremendous. You know, we see that being replicated, quite frankly. And again, all of these companies have impact in the communities, but they are also very strong, economically driven opportunities for us that we're proud to be a part of.
Thank you, Anita. I see we have a question in here too from the audience, and I would just I would just add that these types of programs are available now. They were available after the 2010 Jobs Act. They're now available again because of ARPA CARES Act and of course, the Infrastructure Act, as that was recently approved. So with that, cities and states now have a new source for their 20% match to work with an 80% partner that will, define a common vision for the city's future, and then go execute on that impact mission. So we're really excited to engage with members of this community again, as we have in the past, to talk about how you can use some of these tools to build, rebuild, and transform your cities. There was a question here from a member of the audience about what types of returns we are seeking for our investors. And so we have two different categories of investors. We have kind of the regular mainline investors who are insurance companies, family offices, and the like, and they're typically seeking a 13 to 15% return. We also have government and foundation investors who are typically seeking a return of anywhere between 0% and 2%. The blended average of the two is certainly helpful towards addressing community needs, but I think what's more important is the de-risking of the fund itself that the government participation provides. By putting that downside protection cushion, we're able to work a lot with projects that we're not going to see light of day at a bank or a private equity fund or a traditional equity investor anytime in the near future. So by being able to serve these out of spec types of initiatives, we think we're able to work alongside CDFIs, banks, and other institutions in a community to help expedite and accelerate these transformative changes.
Thanks so much, Jonathan. And thanks to both you and Anita for talking about the work that you're doing. If we can go back 2 slides, and before we transition to Ben, I have 2 questions. I'm sorry, one more to the Snk Healthcare slide. Thank you. Because I want people to focus on this. My first question is, I've spoken with folks, community leaders in the Hill District of Pittsburgh, and I remember in those conversations, they were very much saying, we welcome opportunity zone investments, but only if they benefit the residents of this community, if they benefit, economic growth locally, but don't displace folks. Can you talk a little bit about what your conversations with the Hill District was census investment is being used to drive capital to that community?
Well, yes, what I would say is prior to our engagement with the Hill District, we really looked for, because it's an operating company, so unlike with real estate where the issue of displacement is an issue, this was really being able to keep a company in these communities where the owner was ready to exit. So it was a perfect opportunity for us to retain the jobs already in the communities. This company was already operating inside of Pittsburgh before the acquisition. It had a base of business in Pittsburgh. So this would allow the company to add on to the impact it was having. What we realized about the Hill District is, once the owner acquires the company, we said, okay, let's really kind of have a base here in the Hill District so that we could then reach out into the broader market, into the broader community, and quite frankly, make sure that the services that this company is offering is touching those communities. And that's what you're seeing happening right now. So two things: it kept jobs in these communities because this particular owner was ready to exit. And two, it allows us to build upon that base and expand in the communities that have not yet been touched by this service, and really have a more of an impact within the Hill District specifically.
Excellent. Thank you so much, Anita. Well, I think we're going to transition over to Ben now. Just a reminder for folks, if you have questions, feel free to enter them into the chat. We will have time for Q&A at the end of Ben's presentation. So be thinking and typing. All right, Ben, I'll hand it over to you. I know you had a very exciting day yesterday.
Okay. Well, thank you, Rachel, and thanks to the EIG team for inviting me on this afternoon to share some of the work that we're doing in Baltimore. And it's a privilege to share the stage here with our partners at Arc'teryx, who are really doing amazing things in Baltimore, and we're excited to be able to work with them there. So as Rachel mentioned, my name is Ben Siegel, and I am with the Baltimore Development Corporation, the city's economic development agency, where I serve as the city's Opportunity Zones Coordinator. I've been in this role since late 2018. I like to say without a ton of evidence, but just based on what I assume, that I'm the first full-time local Opportunity Zones Coordinator in the country working at the city level. And much of what I do is around matchmaking. So my work within Baltimore is very focused on developing kind of inventory and pipeline of projects across our city in our 42 opportunity zones, working with businesses, with developers, with community organizations to kind of build out that pipeline and present it to investors. And then on the other side, it's a lot of dedicated work around building relationships with impact investors. That's kind of the group within the opportunity zone space that we're very focused on, understanding what those investors are looking for in terms of their investment and impact criteria, and then really trying to match them up with projects that seem to be a fit, and where we can kind of get matches to occur, to work with both sides and leverage our partners at the city and the state level to try to move projects forward. So it's about kind of doing that matchmaking, taking on some of the opportunity costs, especially for investors who might not know much about Baltimore, to help kind of guide them to neighborhoods and projects, and then really assist our project sponsors, especially those who have limited access to capital markets, to help them identify investors. So with that, I want to talk a little bit about just some of our overarching activity, and then go into a specific project that we just had a groundbreaking for yesterday, which Rachel alluded to, that we're really excited about. So this first slide here is just a quick overview of kind of our approach to how we have viewed opportunity zones in Baltimore City, and how we've looked to take advantage of them to attract capital to critical neighborhoods and projects. So the map here is the city of Baltimore. The light blue areas are our opportunity zones. We have 42 of them, as I mentioned, in Baltimore City. State of Maryland has 149. So we have over a quarter of the state's opportunity zones in Baltimore City. And kind of from the outset, we had identified our strategy for supporting projects and opportunity zones around 3 general categories. And now that we're a couple years in, with certainly some obstacles with the pandemic, we found these original 3 strategies to generally hold up and to generally be kind of the focus of what we've been working on. So kind of I'll just run through these quickly. The first strategy is kind of areas within the city that are critical commerce centers, commercial corridors and areas, and that includes areas like our train station, Penn Station, in kind of the central area of Baltimore. We've seen a really exciting opportunity zone equity investment there in the redevelopment of Penn Station, which just broke ground a couple weeks ago. And that's a massive project that Amtrak is putting a large amount of resources into, other local players, and an opportunity zone fund as well. In addition to Station North, another neighborhood is the Port Covington area in South Baltimore. This is one that a lot of people in the national media like to pay attention to. This is where Under Armour's headquarters are. And there's a massive multi-year development going on here. Goldman Sachs has made some significant investments, including some opportunity zone investments into the projects going on there. And then another area is the Canton District, which is along the waterfront in East Baltimore, where kind of it's a pretty strong kind of office shopping district, and we've seen some opportunities on investment there. Kind of another core category for us are neighborhoods driven by key anchors, universities and hospitals. We were pretty strategic in identifying opportunity zones in Baltimore to be centered around some of those key anchors in our communities, kind of key universities like Johns Hopkins, University of Maryland, Baltimore, Morgan State University. And we've seen some really good investments in those neighborhoods. One example is in one of Hopkins's hospital anchor areas in far East Baltimore. This is an area that across from the hospital was an old brownfield site. It's a food desert. And so we've seen a massive redevelopment of this vacant brownfield into a mixed use development that includes a grocery store, medical offices, and some other community amenities. And then the final strategy, and that's what I'm going to talk a little bit more about with my next 2 slides, is concentrating opportunity zones around targeted, what we in Baltimore have been calling impact investment neighborhoods. So a couple of years ago, our Department of Housing and Community Development at the city level put out a framework for community development investment in the city. And part of that framework looked at the various tools and resources that we would look to bring to the table to invest in mixed income, mixed use neighborhoods. And then it also identified kind of initial series of neighborhoods that we would really be focused on. And these are historically redlined communities in Baltimore that have historically been underinvested in, and have a multitude of challenges relating to that. And it's where we see a lot of our blight and challenges in Baltimore City. And those 4 communities are Park Heights, which is the kind of northwest area. That's the one blue little island up on my map in the northwest. Penn North, which is an area I'm going to talk about, which is just below Park Heights. It's that kind of couple blue tracts that run at a 45-degree angle. And then Southwest Baltimore, is below that in kind of the southwest section above the waterfront in the city. That's where the grocery store investment that Anita mentioned has taken place. And then our Broadway East community, which is in kind of East Baltimore, just east of north and east of the downtown area. So in those four neighborhoods, the city has really taken a targeted approach in trying to support home ownership and rental housing at an affordable level, kind of build out new green space and parks, bring in community facilities, renovate and upgrade school buildings, and then also support small business corridors there as well. So I want to talk about a specific neighborhood and the specific investment on my next slide here. And this is the Penn North community. So this is in West Baltimore, in kind of that West Baltimore, Penn North area that I just mentioned before, one of our impact investment areas. Just quickly on the map, this map here actually comes from that report I mentioned that our Department of Housing and Community Development put out a couple of years ago. That's the cover of the report, A New Era of Neighborhood Investment. And I'm not going to walk through everything here, but the key thing that I want to point out is that the vision for these impact investment areas is recognizing that, you know, in order to have the comprehensive neighborhood revitalization outcomes that communities want to see, that we at the city want to see, it's got to be not just a one-off project. There has to be kind of multiple projects that, you know, all have their own kind of approaches and capital stacks needed and kind of various inputs required to be completed, but that they also kind of fit into a broader neighborhood and community level strategy. And so just kind of quickly on this map here, this neighborhood is named after the two main thoroughfares, Pennsylvania Avenue, which is kind of diagonal thoroughfare kind of running from the top left down to the bottom right of the screen, and then North Avenue, which is Baltimore City's main east-west thoroughfare, and that's kind of about in the center of the map there, running straight across. And so the different numbers in this map represent different projects that the city's involved in. For example, on the right side, number 2 is the redevelopment of a brand new elementary school. Some of the other projects on here are affordable rental housing. There's some affordable home ownership projects. There's a park in kind of right at number 4 where it says Druid Heights. That's one of the neighborhoods. And there's some business development is there as well. And in addition to those projects, you know, to really make a neighborhood like this go, there's other projects, you know, that you know, developers will be taking on and will be attracting opportunity zones and others investments. And that's one of the projects I want to talk about. And that's the one that's labeled NAM, kind of on the left middle of the map there. It's the project is, NAM stands for North Avenue Mixed Use Project. So this is a project, actually that's what it currently looks like right now. If we can go back on, I'll just walk through the capital stack and we'll show the picture. So this is a project that a local developer has taken on. And what the project will be doing is redeveloping a row of abandoned row homes in Baltimore City at the Penn and North intersection. It's a symbolic area in that those who remember the uprising in Baltimore from 2015 after the death of Freddie Gray, what was always on CNN on kind of a 24-hour loop was the burning of a CVS. And that CVS is right at this intersection. It's on the northeast side of the Pennsylvania North Avenue intersection. This project is right across the street on the northwest side. And so this row of abandoned row homes, which sit next to a church on one side and then next to an office complex on the other side, are going to be redeveloped into 20 units of rental apartments, 15 of which will be set at affordable at 50% area median income. Then there will be 4 ground floor office and retail locations, which are going to be kind of reserved for and marketed to local businesses, focus on Black-owned businesses being able to to occupy those locations. And what's really amazing about this project is that it is the first multi-family zero energy project in the state of Maryland, something that we're very excited about. I just want to kind of talk through the financing of this, because as everyone knows, with these projects in a neighborhood like Penn North, it takes a lot of partners and it takes a lot of forms of capital to make this work, even for a relatively small project. So overall, this is about a $5 million project. I'm just going to talk through the sources of the capital. I don't have all the specifics, and I'm not going to get into the details on all of the returns for the different forms of capital and the different rates for the debt side and returns on the equity side. But generally, just to give you a breakdown, an idea of how this works, this project includes debt, equity, and subsidy. And the equity is coming from an Opportunity Zone Fund, the CEI Bulos Wood Forest Fund. They're in the project at about 20% of the total costs. Enterprise Community Partners is providing a loan at about $1.5 million, and that's being matched by a local CDFI that is supported by Baltimore City called the Neighborhood Impact Investment Fund. Anita mentioned them, is also a partner in our Terraces Fund in Baltimore. So they're providing debt for about $1 million. And then there's a pretty good amount of subsidy in here. So Baltimore City has provided a grant through our Affordable Housing Trust Fund. This was a competitive grant that the project sponsors had to apply for. And then the state has provided some subsidy funds from a couple of different state level pots of funding. And so the kind of, the lesson here is that this project, has certainly taken a lot of work to get over the finish line. And it, really required all of these various pieces to make it happen. And it wasn't by accident. Oftentimes we have like a project that's an exception that like through, accidental, kind of streams of funding, it kind of gets across the finish line. This is a project that really grew out of the partners at the city and state level working very closely with the developer. One kind of side note that I just want to mention that has been kind of a local innovation for us in Baltimore, in part spearheaded by Opportunity Zones, is that we, in Baltimore, we hold a monthly meeting with all of the key agencies at the state and city level involved in projects like this. In the past, our state housing, our state commerce, our city housing, our city economic development agency, we're all working on projects, and in many cases the same projects, but we were never overly intentional in coordinating with each other. And by instituting these meetings, which we've now been doing for a couple of years, on a monthly basis, we walk through all the projects we're all working on, and we're able to, identify where there's gaps, where there's overlap, where we need to prioritize, where we need to work together to make sure that, we're able to help move projects over the finish line. And it especially became important to do this with Opportunity Zones where things are on a very tight timeline and schedule, as Rachel had alluded to earlier today. And so this project is really our prime example of how all of the key partners at the city, state level work together to make sure we aligned our resources in a way that we could meet the deadlines of the Opportunity Zone Fund and we could get this project financed. And that's even, during the period of the pandemic, from when we started to when we got done, the budget went up by about 20% because of increased construction and materials costs. So go to the next slide, just a couple of quick pictures of what this looks like. This is kind of what this block currently looks like. This is looking west from the Pennsylvania Avenue side. This is along North Avenue. On the left is the church that these buildings are connected to, and that's the row of houses. Go to the next slide. This is what it'll look like when all is said and done. When the project is complete, the rendering of it. And then the final slide is from our groundbreaking just yesterday. So we had an amazing event where we brought out the folk leaders from the city, from the state. We had the Opportunity Zone Fund there, obviously the developer, kind of all the key local elected officials, and we were able to celebrate this project. And just in closing on this, what we are most excited about is this is a blueprint for us. The Opportunity Zone Fund that we worked with on this project, I think was, and they said it yesterday, they were very grateful to have a partner at the city to help guide them to projects, to help move things through, to help feel them reassured that the city and state funds that needed to make this happen came through as they did. And this fund is now excited to work with the developer and with others in Baltimore on other similar types of projects, which we're really excited about. And then I have one more slide here. I'm not going to go into detail here. This slide is an example of one of our other impact investment areas that is a little bit more focused on operating businesses. So this is the Broadway East community in East Baltimore. This is a neighborhood that historically, has been a place for industry. We've had breweries here back in the heyday in the early 1900s. There is a major municipal water pumping station in this neighborhood. It is also a residential neighborhood. It's just north of the Hopkins Medical Campus. That picture that you're looking there is looking from the neighborhood to the south with the bigger buildings in the background there. That's the Hopkins Medical Campus. And so this is a neighborhood where there has, with New Markets tax credits and other types of investments, been some good revitalization of some of the industrial buildings. We've had then opportunity zones invest in a couple of companies that have moved into this area, including an animation studio that was founded and is led by a former Baltimore Raven named Trevor Price. And we've been working with Trevor and other community leaders on a vision for trying to turn this neighborhood into kind of what Trevor likes to view as a Burbank of the East. So building out kind of a whole animation studio type of industry cluster here. So we're working on plans for this, and we'll be excited to see if this is a type of area and types of investments that Opportunity Zone funds will be interested in supporting. So with that, I'll close it out, and certainly happy to answer any questions. I'm sure Jonathan and Anita are as well.
Yeah, thank you so much, Ben. Really, really appreciate that. And congratulations. I know that sometimes it takes a while to get projects over the finish line. And as a Baltimore representative and someone who's worked so hard to ensure that investment activity is happening across the entire city, this must have felt great to get some shovels in the ground, or at least some people out to celebrate with you. So
shovels were in the ground. They actually started working on the project last week. So it was cool. At the groundbreaking, there was actually some of the workers in their hard hats on and hanging out. So that was good to see.
Oh, well, we're also happy to see groundbreakings are back post-COVID.
Right.
Those are always fun. One quick question for you, and I just want to note for folks, we're about 1 minute out. So everyone has been kind enough to offer their email addresses right here. And I think we have time for one question, and Ben, it's for you. How long did it take to put the capital stack together at Penn North?
Yeah, I mean, it's a good question because it's kind of like a fluid answer. So what I can say is that, I began working with the developer in kind of late 2019. That's when he kind of began the acquisition process for the properties. And then really in earnest, the conversations began in summer 2020. And that's when we made the original connection between him and the Opportunity Zone Fund. I think we had our original meeting in August of 2020, I want to say. And then from there, the Opportunity Zone Fund was interested. They were originally looking at making their investment by the end of that year, 2020. The developer, had secured some state money. He had kind of enterprise in conversation, but that didn't go through. Then kind of so that's kind of fall. By the end of 2020, he had most of the pieces lined up of what he was looking for, but then it took a little while. So the $750,000 from the city came in in April. It was approved in April. And then after that, that's kind of what everyone else was waiting for. So once that money came in, then Enterprise came into the project, finalized, their term sheet, the Neighborhood Impact Investment Fund finalized. And so, it's kind of like a chicken and egg thing, everyone waiting for this piece to fall or that piece to fall. So, I would say, then kind of everything was finalized really, over this, kind of fall, end of summer, fall. So, it's about a good year and a half, almost, 18 months, 2 years. So,
Yeah.
and that's where it gets challenging. And I guess for me, where I often get frustrated of like, well, these projects would have happened anyway without opportunity zones. It's like, maybe not. We don't know that. I mean, and like, while it sounds like that was a long time, that's actually a pretty quick pace for a project in a neighborhood like this. I mean, you go around and look at other projects in this neighborhood, there's vacant row homes that someone has acquired, 5 years ago that are still sitting there, and they're trying to put together the package. So, so while it might seem long, it's not as long as a lot of the types of projects that it takes to get through the finish line in these neighborhoods.
Yeah, and that's exactly what I was going to say, just to co-sign you on this. Like, that's project financing. It has nothing to do with opportunity zones. And to your point about vacant row homes sitting empty for 5 years, the policy design really helps to ensure that that doesn't happen, because you have substantial improvement requirements and timelines around that. So it really does create an incentive for folks to get to the table and close financing. So
yeah, and I'll just say a lot of it's such a balancing act. I mean, and it's like, again, the role that we play within the city is trying to be an honest broker, but also trying to like hold a deal together. I mean, with this project, basically, if that grant from the city, from the Affordable Housing Trust Fund, had not come through, the opportunity zone probably would have walked away. We would have then lost, the debt capital, and this project would be another group of row homes sitting there vacant that would have gone kind of back to the drawing board. So it's like, getting that one key piece then allows all the other pieces to come on board.
There you go. I think everyone can tell we all could collectively talk about this for a very long time, but we are 3 minutes over. Thanks everyone for sticking with us. I did put those additional resources and links into the chat box, and as always, take a look or wait for our notification. We'll be posting this in a blog. So thanks for joining us. Appreciate it.